Hey everybody, welcome to Money's No Object. I am your host, Dylan Howell. This is episode number 37 of our YouTube channel and podcast, and I could not be more excited to continue working with you guys and talking about personal finance topics that I think are really useful to you and can help you in your long-term wealth building journey. Today, we continue talking about things that are mistaken for investments and that are not actually investments. And in doing so, we're going to talk about one of the most misused products out there, and that is life insurance policies. And we're really going to dive into the fact that these are not necessarily bad things. In fact, they can be very good things. But the problem lies in the way that individuals use them, and they should not be used as investments. But first, if you could, go down below, subscribe to this channel, like the video, click the thumb button. That'd be really helpful for me. Leave me any just feedback that you have in the comments as we go along, and that would be really helpful. Also, if you are listening on Apple or Spotify podcasts, I really appreciate you. If you could, just go ahead and subscribe to this show, and you can see all of the content that we put out from here on out. Also, follow me on social media at MNO with Dylan and check out the content I'm putting out there. And if you want to work with me one-on-one, if you want to dig a little deeper into your financial life and create a financial plan that works for you, check out my website, www.mnowithdylan.com, to see the financial coaching services that I offer. Now let's go ahead and start in a really simple place. What is life insurance? Life insurance is nothing more than an agreement between you and an insurance provider that is saying that if you pay them some monthly payments or semi-annual payments or annual payments, however you have it set up, if you make some payments to them, then upon your death, they will pay some predetermined sum that you all agreed on to the individuals that you say to leave that sum to. And you buy life insurance not because you're going to die, but because your loved ones are going to live. People rely on you and rely on your income. And so life insurance is a great way to just add a safety aspect to your life. If your family is relying on your income, they can get this sum and use it for the purposes that they need to move along with life. And what you really buy with life insurance is peace of mind, because life insurance can cover, like I said, a loss of income. It can cover debts that you left behind. It can cover funeral expenses if need be. And all of these things just allow the individuals that are going to have to deal with your final wishes to be able to do so with some money and not have to scrape something together for them. So it is a very useful thing and should be done to take care of those who are still here when you aren't. And so how does a basic life insurance policy work? Well, it's really, really simple. So all that there is there's the policy, and the policy is basically the agreement that was made. There are premiums, and premiums are what you pay to the life insurance company in exchange for the coverage that they give you. There's the policyholder, which would be the individual who purchases the policy. So in this case, if you buy life insurance, you're the policyholder. Then there is the death benefit, and the death benefit is nothing more than the amount of money that they will pay if you were to pass away to your beneficiaries. And that brings up the beneficiary, and the beneficiaries are the individuals who receive the death benefit upon your death. So in general, life insurance is a really simple concept, but it does get heavily misconstrued. And so what are the types? Well, there are two main types of life insurance, and they each have subtypes, but I just want to stick on these two main types. There's term and there's permanent. And so term life insurance says for some predetermined amount of time, so 15, 20, 30 year term, then you will pay premiums and you will be covered with life insurance from some insurance provider. So that's what the term life insurance says. Now, then there is permanent, and permanent differs, and it is, as it says, it is permanent. It is going to last the entire term of your life. It's not just a predetermined number of years. And these different types of permanent life insurance are called things like whole life, universal life, variable life, things like that. Those are these permanent life insurance policies. And what happens there is not only is there a death benefit to your life insurance policy, but the insurance company also takes a chunk of the premium, which is generally more than the term premiums by a good clip, and they put it into an invest for yourself type of account, and they call that cash value of the permanent life insurance policy. And this is where it gets really hairy, and that's what the genesis of today's video is that insurance policies should not be used as investments because they aren't investments. And we're going to talk about why here in a second, but that is the genesis of this video, and that is what a permanent life insurance policy is. And so then the question becomes, well, should you even have life insurance? Dylan, you say the life insurance isn't an investment, then why should you even have life insurance? Well, yes, if somebody relies on your income, then yes, you should have some type of term life insurance, some length of term life insurance. And only term because the cost only makes sense with term. What you're paying for only makes sense with term. And life insurance is definitely worth it, but it's all about having the right type of life insurance, and that's what makes all the difference. So let's turn for a second and go, okay, well, is this an investment? Well, I've already spoiled the milk there, but I'll go ahead and talk to you about why I feel the way I feel. But we're going to look at this objectively and say, okay, well, is life insurance an investment, and should we use it as such? So once again, the two definitions that we play by here are the investment definition from Graham and Dodd in their 1934 book, Security Analysis, and Jesse Livermore's definition of what speculation is. And so let's talk for a second about what those definitions say. So the investment definition is the following. An investment operation is one in which, upon thorough analysis, provides safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. Okay? And then there is the speculation definition, and that says the object of a speculator is not to secure a steady return on his money at a good rate of interest, but to profit by either a rise or a fall in the price of whatever he may be speculating in. And so you see how those differ very boldly. It's a big difference between what investment and what speculation is. So then we ask ourselves the question, does life insurance provide safety of principal? Because that was the first part of the definition of investment. Well, the short answer is it depends. So the money that goes into the cash value of a permanent life insurance policy, and like I said, that's the genesis of this whole question. The money that goes into a permanent life insurance policy, it is yours. But in almost all cases, if you are to die, your beneficiaries only receive the death benefit. And that's an issue because that means the safety of principal was not there in the money that you thought you were investing. That means that what you thought was an investment, in fact, was not an investment. It was just some money that you were laying aside, and it was lost in the shuffle. So that's not always the case, but in mostly all of the permanent life insurance policies, that is the case. And in such cases, the extra premiums that you paid to put money into that cash value were really all for naught. And you may say, well, Dylan, I can pull the cash value out before I die, and then it looks like an investment to me. I made money on it, and I take the money out, and now the money's mine. But how do you know when you're going to die? How do you know when it's the right time to take that money out? The problem is you don't. And if you knew, then that would make perfect sense. But the fact that you could die today, all of us could die today, there would be no way to get that money out. And that is an issue. And let's not forget that life insurance policies thrive on premiums. So let's say that you don't have an auto draft for your premium and you make your premiums on your own schedule. And let's say somehow you fail to make a premium payment. Well, that can be a big issue. And why that could be is because fail to pay your premium can void your policy. And so you can lose everything that you had there in that built up in that cash value if you don't pay your premiums. So again, safety of principal is extremely questionable here. It can be the case, but it doesn't look really promising. Then we ask, does life insurance offer a satisfactory return? And because that's the second part of the investment definition. Well, no, that's emphatic no. And here's why. Because even with permanent insurance policies that are variable or have indexed options, right? So being indexed means like following the S&P 500, or being variable, meaning being put into different funds like mutual funds and things like that. Even though that can be done, not arguing that here, the fees are crazy. And the problem in these particular types of accounts is that you are making the insurance company money that you don't have to be paying to them. So if you want to invest money in an index fund, it's almost costless, and it is costless at some companies. So why would you pay to be indexed to anything? Doesn't make sense. It absolutely doesn't make sense. Or why would you pay fees for a variable life insurance policy when you can just put your money in the mutual funds you want to put them in and allow it to be variable on its own? And another issue with this is that a lot of these policies only allow you to get a percentage of the returns of an index if you're indexed, or a percentage of the returns if you're variable. And that's a big issue too, because if you're investing, you want to get all the net returns you can. And so if they are capping your returns, that's what that's called, capping your returns. So if they're capping your returns and taking pretty substantial fees, then those things together eat at net returns more than anything. And that's going to be a problem for you long term. And so it is not going to provide you a satisfactory return for an equal amount of risk that you would be taking. And then basic cash value policies that are not variable or indexed are trash rate of returns. And so there's really, really, really no reason to think of that as an investment, because it absolutely is not offering a satisfactory return to you. So what makes life insurance, and specifically permanent life insurance, not an investment? Well, let's think back to the couple of things we said. Safety of principal, not sold. So first, there's too much ambiguity as to whether you're going to get your cash value back or not. And I really hate that. I want you to be able to get the money that you need from your investments. And I want your beneficiaries and the people who are left behind you to be able to get their hands on the money that you leave behind, and not just allow that money to go down the drain in a cash value life insurance policy like it typically does. And then returns are subpar at best. And we just talked about that. The biggest issue here is after fees. I mean, net returns are going to get eaten away by the fact that you're paying exorbitant fees for the ability to be indexed, or for the ability to have a variable portion to this life insurance policy. And that's too much for the exact same thing you can get for almost free, if not free, if you're indexing. And so let investments be investments. And a good way to tell that something is not is if it says insurance policy on it. And so just make sure that that's the case. It's just really, really hard to justify having something that you're pouring money into that is not guaranteed to give the money back to you. And so that issue is the primary reason why I say this is not an investment. And it's really hard for me to talk this way, especially about life insurance, because life insurance is not bad in and of itself, but these particular types of life insurance that I've really kind of harped on today, they can have really tough implications relative to other things that you could be doing. That it's not worth your time. It's not worth throwing your money away to have this thing and to have this particular type of insurance policy that are so heavily sold. They're sold to everybody with a pulse and a social security number. They get out there and they try to sell these life insurance policies, and they're not out there pushing term. They're out there pushing whole life. And the reason that they are, just for your information, the fees. They make more money on these whole life insurance policies, just period. And so be smarter with your money. Do things that are investing with your money. And insurance policies just aren't that. So it's not an investment, but should it be used at all? Life insurance. Well, like I said earlier, term life insurance is necessary. If you have people who are going to need your income over the long term, you need term life insurance, period, end of story. You have a child, you have a family, you have a wife, you have a husband that relies on your income, you need it. So just make sure that you get that in place. And that is a great idea, and that's a great thing to do. But again, not investing. Insurance is insurance, investing is investing. Insurance is where I put money, where I'm spending money to protect the money that I do have, to protect the people that I do love, to protect the things that I do have. But investing is the money that I have growing for me. So you can see it's a distinct difference. That's why I talk a lot about when you're looking at your emergency fund, look at an emergency fund as an insurance policy, because it's not growing for you. It's not an investment. It's just money that's going to be there in case you need it. And that's the same thing that insurance policies need to do for you. And that's it. And just know that, and if you don't already, term life insurance is so cheap if you're young and healthy. If you're in your 20s and you are really, in at least decent shape, then term life is just crazy cheap, and you can lock in fixed rates on term life insurance. So if somebody relies on your income, you should definitely look into doing that for yourself and your family. Now, a problem that you run into often is that older individuals, because I've seen this, older individuals, maybe with a few more health concerns, or just the fact that they're older and can't make it to the end of a term policy anyway, can only get permanent life insurance. And if they're in that position where somebody's relying on their income, they don't have a nest egg that's really built to a portion where you can kind of self-insure yourself, and they need to have this life insurance policy, I'd say just keep it as long as the premiums are reasonable. If the premiums get out of hand, which they have a tendency of doing in your older age, then get rid of it and just invest the money for yourself and allow yourself to keep the money that you're putting in, and not worry far too much about leaving a death benefit. Just make sure that you're saving money to leave it behind for your family. That's just a tough place to be in. And what I'm trying to get you guys to, especially you individuals who are in your 20s, 30s, 40s, is that you can have a term life insurance policy, most of you, and you can invest your way to having a fair amount of wealth to where when that term runs out, you don't need life insurance anymore, because the people that rely on your income will be taken care of by the nest egg that you leave behind. And something I would say is, if you are buying a life insurance policy, if you're an elderly individual who's looking and you can only get permanent or something like that, never use life insurance if you are expecting your money to grow. Because the truth of the matter is that returns are not that good, and they can be capped. Your fees are going to be really, really high, and they can put restrictions on the amount of money that you can take out. And so these are things that I've talked about before. I hate restrictions on my money. And so if the advantages don't outweigh the restrictions, which they absolutely do not, because I just told you the advantages aren't there and they restrict, then this should be something you definitely look away from. It's something that I haven't talked about today that is definitely a life insurance product is an annuity. And when I talk about permanent life insurance products and then I dig into annuities, yes, they differ from permanent life insurance policies, but a lot of the same things apply. So do they provide safety of principal? Well, yes, they do. That's what annuities are really made for, is the safety of principal that they will provide individuals looking to put their money somewhere. They will provide safety of principal, which I am perfectly cool with. But then their net returns aren't as good as the market, and there are just a lot of bad ones out there. There are so few decent annuities out there that you almost just put the blanket statement of stay away, because a lot that applies to permanent life insurance also applies to annuities. Their fees are high. There are a lot of restrictions in trying to get your money out if you don't like what you've put your money into, or if you need that money for something. There's typically just a ton of restrictions on being able to get the money out. I'm just not a fan of putting your money in annuities, because restrictions for not as much upside. And so that's just a really tough thing for me to reconcile, especially if you're in some kind of indexed annuity that, why don't you just go buy an index fund? I mean, long term, you're just going to be better off. And I know that people's risk profiles differ, completely understand that, and people want that safety of principal. But if you're looking for allowing your money to grow and you're looking for a certain safety of principal, understanding stocks, bonds, good investments, mutual funds, ETFs, things like that will allow you to better invest your money and put it in things that are going to work for you better long term, simply because you understood it. And that's the problem with a lot of people who buy annuities. They fail to understand good investment practices and how investments perform long term, and then they are enticed by the safety of principle. And so I don't want you guys to fall into that with the permanent life insurance or annuities. In most cases with the annuities, just say no. And with just about every case with the permanent life insurance, just say no. And a real simple rule of thumb is invest with investment companies, buy insurance from insurance companies, but do not invest with insurance companies, because it's just not what they do. If they're trying to do something like that, doesn't it just sound like they're trying to make more money? That's what it sounds like to me. So just say no to that. So what do we know? We know that there's a need for life insurance in the world, 100%. I'm a firm believer in life insurance policies, but I don't believe in this idea that you can invest in a life insurance policy. Doesn't make sense. Doesn't meet the definition of investing that's gotten so many people wealthy over the long term. It's not an investment. It is insurance. It can help your beneficiaries over the long term, but let's buy life insurance in an efficient way and a low cost way, and invest in an efficient way and a low cost way, and not try to slap everything together, throw a bunch of fees on top, and do everything at once. And it just doesn't work. It's 100% a way that insurance companies can make money, and that can make you struggle to build wealth long term if you're purchasing these things. So just keep your mind set on, okay, I need some type of term life insurance if somebody needs my income, and I need to be investing. I need to be investing in investments. And we've talked about what those are. We've talked about what investing is. And as you see, anything that is called an investment, you can put those definitions of an investment and speculation up to them and go, okay, well, what are these things? And I'm really just trying to keep you guys out of the trap of bad investments and out of the trap of things that are not investments at all. And so don't even speculate in life insurance policies. Find your way to investing in things that are good and investing in things that are going to not restrict you and give you a lot of long-term opportunities to build wealth. So hey, don't forget to subscribe to this channel. Don't forget to click the like button. Continue leaving me any kind of feedback in the comments. I'd be glad to get back with you guys. Also, if you're listening on Apple or Spotify podcasts, I really, really appreciate you guys. Just go and subscribe there as well. Leave me a review, hopefully a good one. Also, follow me on social media at MNO with Dylan. And man, I'd just love to see you guys follow there, and you can learn a lot from the things that I post on a day-to-day basis. And I hope all that kind of stuff is helping those of you who are seeing it, and it can continue to help new people as they come along. Also, if you want to work one-on-one, if you want to be coached by me on your personal finances and create a financial plan that works for you, then go to my website, www.mnowithdylan.com, and you can sign up for a financial coaching session there, and we can start getting this ball rolling of creating you a financial plan that's going to work for you over the long term. So look out tomorrow when I start talking about investments that are investments, but are typically no good. And I'm going to start talking about leveraged ETFs tomorrow and the dangers of investing in leveraged ETFs when we come back together tomorrow. That's going to be a really interesting one. If you've never heard of leveraged ETFs, you'll start to understand why I feel the way I do about them, and how you can guard yourself against, once again, another product that of the financial world, a product of the financial world that is probably not going to do you much good. And we'll look at that again come tomorrow. So hey guys, thanks for watching this episode of Money's No Object. I am your host, Dylan Howell. God bless.